Hello friends, good evening, greetings to all of you. So here I, Kunal Nagpal, welcome you back once again to this amazing economic interaction. Dear friends, I really hope you had an excellent day and I wish to discuss the topic of great interest in these evening hours. So now we are going to discuss the topic which is actually gaining momentum nowadays. That is the topic of digital rupee, that is the CBDC, the central bank digital currency. And how is RBI retail e-Rupee different from other modes of payment, that is UPI, NEFT and RTGS? Basically, the Reserve Bank of India recently launched the pilot for its digital rupee, India's very own digital currency. And it's actually the need of the hour. As the era of digitization is coming, so it's very important to introduce this concept. A central bank digital currency, that is a CBDC, is actually a legal tender issued by the central bank in digital form. It is the same as a fiat currency and it is exchangeable one-to-one with the government issued money. Simply put, the digital rupee is actually the same as a banknote or coin that we use daily, only it is in a digital form. How is the RBI's retail digital rupee different from the Unified Payment Interface, that is UPI, National Electronics Fund Transfer, that is NEFT, and Real-Time Gross Settlement, that is RTGS? Let's find out and let's have the basic clarity on this particular aspect. Understanding the digital rupee. What is actually the digital rupee? The retail digital rupee is a digital token issued by the Reserve Bank of India. The central bank has basically identified 8 banks for the phase-wise pilot launch of the retail digital rupee. 4 banks, including the State Bank of India, ICICI Bank, Yes Bank and IDFC First Bank, are taking part in the first phase of the pilot program, while the Bank of Baroda, Union Bank of India, HDFC Bank and Kotak Mahindra Bank will join the pilot in the second phase. It has been issued in the same denominations that the paper currency and coins currently in circulation. At present, customers will be able to transact using the digital rupee through a digital wallet offered by the participating banks in the pilot program. The digital wallet can be saved on an Android smartphone. Currently, the customers and merchants in the closed user groups, that is CUG, in select locations in Mumbai, New Delhi, Bangalore and Bhubaneswar can use the retail e-Rupee via the e-wallets of the above mentioned 4 banks taking part in the launch, according to the RBI press release. The users can link their wallets to their bank accounts and load them and use the digital money for individual payments or at the merchant shops. To send or receive the digital money, a wallet is a must. e-Rupee will actually make life easy by providing instant transfer of funds of the customer. There is actually no requirement of settlement for the banks or the ecosystem participants and no need to print or manage the currency notes or coins for the regulator or the banks or participants, said Mr. Mihir Gandhi, partner and leader, Payment Transformation, PwC India. Now, dear friends, let's note the differences between e-Rupee and UPI, RTGS and other payment options. There are basically 5 differences, that is e-Rupee. Firstly, e-Rupee is the legal tender and not a payment medium. e-Rupee is actually an electric form of sovereign currency, while the UPI applications such as Google Pay, Phone Pay, NEFT, and RTGS are different methods of transferring the funds or payment mediums. That's the basic clarity of the concept. The main difference is that the UPI transactions are completely backed by the physical currency, and the digital rupee is actually a legal tender not supported by a physical currency. Explained Mr. Rachit Chawla, CEO, Finway FSC, a fintech firm. Secondly, the digital rupee is not limited to just currency. It must be mentioned that the usage of the e-Rupee is actually not limited to the payments, as it is a type of currency. The digital rupee also serves the purpose of making the payments much easier. That is, it is actually a unit of account and, more importantly, a store of value, said Mr. Ajay Rajan, Country Head, Transactional Banking, Yes Bank. The key difference between the digital rupee and UPI is that the digital rupee is a store of value like the currency itself, and UPI is just an overlay infrastructure on top of any form of store value like bank accounts, which have the normal currency, prepaid instruments, credit cards, etc. UPI can be an overlay on any store of value. The e-Rupee is a store of value that can be transferred digitally, instantly, with finality of the settlement, said Mr. Gandhi. Moreover, the digital rupee could potentially have the additional attributes specific to the currency, which may be tested in future pilots, Mr. Rajan added. Explaining the use cases of e-Rupee, Mr. Gandhi said, e-Rupee can be issued and used for multiple use cases beyond the traditional payment transactions going forward, like embedded or ecosystem finance, instant lending, trade finance, etc. It has the potential to be widely accepted and replace the physical currency with digital money and use it for various transactions fulfillment. Third difference is there is actually no intermediation of banks in case of digital transactions. The digital transactions using the digital money. That's the main difference. That is, the digital transactions in UPI or NEFT or RTGS must go through a bank, while in the case of the e-Rupee, that is in the case of the digital rupee, the money gets transferred from one wallet to another. That is, it is just a mechanism of transferring the money from one wallet to another. So as mentioned earlier, there needs to be the involvement of a wallet. It is very necessary in case of the digital rupee. So classifying the difference between the digital rupee and UPI, RBI Governor Mr. Shaktikant Das had said during a press conference on December 7, 2022, any UPI transaction involves intermediation of the bank. In CBDC, just as the paper currency, you go to a bank, draw the currency and keep it in your purse. You go to a shop and pay from your wallet. Similarly, here also, you can draw the digital currency and keep it in your wallet, which will be basically in your mobile phone. And when you go and make a payment in a shop or to another individual, it will move from your wallet to his wallet. That is, there is no routing or intermediation of the bank. Next, anonymity is a big factor. The transactions via the digital rupee are more anonymous than the current digital transactions, including UPI, NEFT, RTGS, mentioned experts. The fundamental feature of cash is anonymity. So for anonymity purposes, the currency can be used. How anonymity will be ensured in the case of the digital rupee can have various suggestions. We are firstly looking at largely the technological solutions. It is also possible to get a legal provision to ensure anonymity, RBI Deputy Governor Mr. T. Ravishankar said earlier. In the case of the digital rupee, even though the transactions are recorded in the centralized ledger, it is fairly anonymous as the owner of the wallets are not known to the government or the intermediaries in the ecosystem, said Mr. Karan Mehta, founder and CTO, Ring, a fintech app. In the case of UPI or NEFT or RTGS, the transaction happens between the two bank accounts and it can be easily tracked. The UPI transactions are all linked back to the bank account and can be tracked by the regulatory intermediaries in the system, explained Mr. Mehta. Now the fifth difference is that it will require the PAN for digital rupee transactions after a certain limit. At present, that is currently, a person making a cash transaction above a certain threshold needs to submit his or her PAN number, that is the permanent account number. The same rule will apply to the digital rupee. There is actually no difference between the paper currency and digital currency, as we have been mentioning again and again. The Income Tax Department has got certain limits for the cash payments, like beyond a certain limit you have to give the PAN number. The same rules will apply in the case of the CBDC because both are the currencies, Mr. Das added. For the digital rupee users, SBI has allowed 1 lakh rupees holding limit for the wallet. Users can load or unload up to 25,000 rupees per day as per the website. Up to 20 transfers including inward and outward payments are allowed in a day. Users can pay or collect up to 10,000 rupees according to the bank's website. So at present, the upper limit per UPI transaction is 2 lakh rupees. However, the upper limit may vary from one bank to another. So dear friends, I really hope that you must have got the in-depth clarity about the difference between the e-Rupee and that is the RBI retail e-Rupee, that is the CBDC, and other modes of payment, which are actually the modes of payment like UPI, NEFT, and RTGS. So we can conclude that CBDC is actually not a mode of payment. It's actually similar to the paper currency, but other mechanisms like UPI, NEFT, and RTGS are the modes of payment. Right? Now, we are going to consider another important aspect today, the discussion which we had today afternoon, that is the textile industry of India is actually not faring well. Now let's understand why it is not faring well. What are the challenges it is facing apart from the global headwinds? So the India's textile industry is facing tough times as the consumers cut spending. India's $200 billion textile and apparel industry is facing a crisis as the consumers in the United States, Europe, and other big markets have cut spending on the clothing following a surge in inflation after the war in Ukraine, industry officials said. So as we had said that the global headwinds are playing a major role in the overall degradation of the performance of the textile industry in India. And apart from that, there are various other reasons. Let's explore. While the overall economy is relatively strong and is outperforming the major economies, the textile sector is a notable exception, and orders suggest the downturn will continue well into 2023 as well, raising the risk of layoffs in an industry that employs more than 45 million people. The exports, which constitute about 22% of the industry have fallen for 5 months in a row, declining over 15% year on year in November to $3.1 billion. The domestic sales are sluggish despite the strong growth in the overall economy because of high costs and cheap imported garments, manufacturers say. After bumper sales earlier this year, the local textile factories are now cutting production, contributing to a 4.3% contraction in the manufacturing of the output in July-September quarter that has raised concerns among the policymakers. But on this note, I would like to mention that as Dr. Nirmala Sitharaman has said, that though the manufacturing sector has been facing challenges in these times, but still we will not shift our focus. We will not shift our focus from the manufacturing sector. We will make full efforts for it to prosper again. Next, the shock comes as the Prime Minister Narendra Modi's government struggles to create employment for millions of youngsters entering the job market each year. After 18 months of robust growth through mid-2022, the global retail sales of clothing have been dragged down by high inflation and depressed consumer sentiment, and prospects for 2023 look gloomy, a McKinsey report said last month. In India, the manufacturing sector, contributing 16% of the gross domestic product, has hit by the rising raw material costs and weak demand despite bright growth elsewhere. The manufacturing showed no signs of growth in the first half of the current April to March fiscal year, while the overall economy, helped by agriculture and services, expanded 6.3%. Textile manufacturers, along with the makers of footwear, furniture, electronic and electricals, have been hit as the companies battle to pass on the rising input costs, while the consumers have cut expenditure on these products as they spend more on food and fuel. In the textile industry, manufacturers say higher domestic cotton prices and other costs have hit the profit margins, while the overseas orders for the next summer are down by about 1/3 and domestic demand remains weak. We see the difficult times at least for the next 6 months as orders from the major markets including the European Union and the United States of America have come down substantially, said Mr. Naren Goenka, Chairman, Apparel Export Promotion Council, citing inflation and global headwinds hitting the domestic sales as well. Mr. Sahid Khan, a garments manufacturer in Ahmedabad, the textile hub in Modi's home state of Gujarat, said despite a fall in cotton prices by about 40% from record highs hit in 2022, the profit margins were down due to the lower sales in the domestic market. The interest rates on the bank loans have gone up along with the labor costs, but my sales are down, he said, adding that the domestic cotton prices remained high compared to the global prices. That's what they said in the afternoon as well. And manufacturers were unable to compete with cheap imports from Bangladesh. Local cotton is at least 10% more expensive than the global benchmarks, said Mr. Atul Ganatra, President of the Cotton Association of India. The government needs to scrap the 11% import duty on cotton so the local textile mills can have a level playing field, Mr. Ganatra said. This will allow the mills to have options to import cotton from overseas, which is nearly 10 cents per pound cheaper than the local supplies. The shares of leading textile companies like Irving Limited, Vardhman Textiles, Trident and Nahar spinning mills have plunged between 20% and 40% this year, while the benchmark Nifty is up over 7%. The industry has sought duty-free imports of cotton and interest subsidy on bank loans and expansion of production-linked incentives to face the crisis. The government could soon consider the demands, and an announcement is likely in the annual budget due in February, said the government official with direct knowledge of the matter, asking for anonymity as he was not authorized to speak to the media. Now there is the fear of job cuts as well. Many textile manufacturers who have frozen hiring of workers have warned of job cuts if the government fails to provide the relief soon. In actually the Tirupur district, a knitwear manufacturing hub in southern India employing over 6 lakh workers, many small firms have slashed their workforce as they say they are operating on less than 50% capacity. With annual production worth over $8 billion for domestic and overseas markets, the local industry fears it will suffer up to a 1/3 fall in exports this year from $4.5 billion in 2021-22, said Mr. Raja, former president of the Tirupur Exports Association. There are few orders for the next summer, he said, adding big retailers were asking for heavy discounts to lift earlier booked orders. Sales in the domestic market, which usually pick up during the festival and marriage season starting October, were weak this year, he said. Ms. Chandra Kumar, head of the Sentinel Clothing in Tirupur, said she had let go the 2/3 of the workers and was left with 150, as she was finding it difficult to survive on thin profit margins and few orders. If the current trend continues, I may soon have to shut down the factory, he said. But still, dear guys, I would like to say that this is the temporary phase, and I really believe that this phase may end soon and we shall overcome this period as well, and the textile manufacturing industry will again blossom with great prospects. Because it is heavily export oriented, so obviously it is suffering because of the global headwinds. And not only India, other countries are also facing in some aspect or the other. But if we take a holistic picture, India is faring very well. And we should see the dedication of our leaders. As I had said, Dr. Nirmala Sitharaman has been repeatedly saying, and she has stood, and even today in the conference of FICCI, she had again quoted and again repeated that India's focus is basically manufacturing, though it may be excelling in services, but still it will put its best effort into manufacturing. And we shall overcome this phase very soon, and the textile industry will blossom once again. So dear guys, that's all for today, and I really hope that these two topics, that is the discussion on the CBDC and the basic confusion between the CBDC and the mechanisms like UPI, RTGS and NEFT have got cleared in your minds. Along with that, I also believe that you must have got a clear picture about the textile industry in India in the current scenario. So, dear friends, I hope you all take good care of yourselves until we meet next. And that's all for the day. Thank you so much. Namaskar. Jai Hind.